Okay, I think we are ready to go. Thank you everyone for coming today. This is the Kaiko Research team's first research webinar. Normally we publish a weekly research newsletter and monthly reports, but we thought it would be cool to do a different type of format. And so we're hoping to do these every quarter, but also excited to hear your feedback after this is done. And I'm joined here by Philip Gradwell from Chainalysis, and he is chief economist, and he'll be providing his own unique on-chain insights to Kaiko's market data insights. So I'll let him introduce himself right now. So go for it.
Hey, thanks so much for having me on here, Clara. And hi, everyone. So I'm Philip. I'm the chief economist at Chainalysis. So in a bit of contrast to Kaiko, Chainalysis looks at the activity that's on the blockchain, or at least a contrast until everyone starts doing DeFi. The blockchain is a really interesting data source that really complements the market data that you see in the order books. And Clara and I, because we've actually been talking for quite a while, always exchanging kind of research ideas and trying to understand what's going on in the market from both those sides. So really excited to bring that in this session today.
Thank you. Yeah, and I guess I forgot to also introduce myself. Hello, I'm Clara. I lead Kaiko's research team. And yes, I've spoken with Philip a lot over the past year, and we've gotten to share a lot of ideas. So thank you for being here. So before we get started into the main content, so Kaiko Research, we publish our weekly research newsletter, monthly reports, and then a weekly PDF fact sheet with updating charts. And if you haven't subscribed, definitely go to our website and subscribe. We have really good in-depth analysis. And yeah, we're going to present some of that today. And Philip, do you want to go ahead and explain market intel?
Yeah, thanks. So market intel, it's, if you like, the on-chain version perhaps of some of that Kaiko data. It's really looking at the underlying movement of different cryptocurrencies to help people make investment decisions in assets companies or even in product development. For example, for an exchange, you need to understand how many users you have that might also own other assets. I write a weekly market intel report as well. And so if you go to markets.chainalysis.com, you can see some of the data and subscribe to that.
Great. So this webinar is going to focus on the biggest Q3 trends. And like always, a ton happened in Q3. And when I was reading through all of the newsletters and monthly reports that we've written, really 4 stood out to me. And that was first off the China ban, which happened at the end of September. Also rising dominance of other layer 1 protocols. The third biggest trend was the growing crackdown on stablecoins. And then 4 was the macro environment and how it increasingly is relevant to cryptocurrency market analysis. So going through this 4 key themes, we're going to talk about some of our favorite charts that really explain these different events. So we're going to start with the China ban. First, what happened? So this is not the first China ban. It seems that every few months there is another ban out of China. But on September 24th, China announced that they were banning all cryptocurrency transactions within the borders of China. And so in May, that was the most recent China ban. That's when China really cracked down on miners within the country, and that caused a mass exodus of mining power outside. But this time seems a bit different. This is definitely the most strict ban, and it really has the potential to really shake up cryptocurrency market structure. So here I've charted the market share of spot volume for the 3 biggest exchanges in the world, which all happen to have a historical ties to the Chinese region. So those 3 exchanges are Binance, which was founded in 2017, Huobi in 2013, and OKEX in 2014. And all 3 exchanges will definitely compare each other to each other, and each of them are like each other's biggest competitors. And so I wanted to look at the market share of spot volume for each of these 3 exchanges to see how that has changed over time, especially in light of the new bans out of China. So we can see here that Huobi has been affected the most. So in January of 2021, 24% of total spot volume happened on Huobi, but in September, only 16%. And so in May of this year, that's when China really started issuing some soft bans to exchanges operating within their borders. It wasn't explicit like what happened in September, but actually CoinDesk reported recently that they actually banned the word Huobi from social media networks. And you can really see how that affected the user base within Huobi, which has a very much disproportionate, user base that is based in this region. So that's really interesting, and we'll likely see this trend really gain over the next few months as they continue to limit the access within this region. So Philip, I would say now turning to you, what have you noticed on chain in the region of China?
Yeah, so it's a great introduction to these exchanges. Like, it's important to realize, I think, actually just how much of a sort of behemoth Binance is. Yeah, you certainly see it in that trade data. We also see that on chain. So at the moment, flowing into exchanges every day, there's between a sort of about 50 to 60,000 Bitcoin a day on average. Binance accounts for around 10,000 of those Bitcoin. So, it's receiving about 20% of all of the underlying asset that's actually flowing on the blockchain into exchanges. So it's a big exchange, but Huobi is also one of the larger exchanges on the blockchain and in the markets. And what's interesting is that they have both historically been major destinations for freshly mined Bitcoin. So there are miners who provide hash rate to mining pools. Those are used to solve the sort of puzzle that allows a new block to be produced and generates this block reward, and also earns fees. And then those Bitcoin are distributed via the mining pools to the miners. And a lot of people think that miners actually hold their Bitcoin for a long time, and sometimes they do, but they have costs that they need to cover. They've got those electricity bills, they've got those hardware bills, and so they will send Bitcoin to exchanges to cash out. Or maybe they actually are a bit short on the asset, and so they want to sell before they think the price is going to fall. So that's why miners send Bitcoin into exchanges. And what we're looking at here is the amount of Bitcoin that's going to these exchanges every day on a 14-day moving average. And if you look at the sort of far right of this chart, you see that actually in September, the amount of Bitcoin going to Binance from miners has actually been increasing. Whereas in Huobi, it's actually been flat, if not decreasing. Other interesting thing to note is that spike in May when the Chinese government started to take more action against miners rather than the whole crypto ecosystem. So we're potentially seeing some response from the miners in the region. But what's interesting is they're actually sending more Bitcoin to Binance, which suggests to me that Binance might be being a little less affected or seen as a better destination to send your Bitcoin in the face of this crackdown than Huobi.
Yeah, I definitely agree with that, especially when looking at market data. It seems that Binance is definitely a global exchange, whereas that might not necessarily be the case for Huobi, which has maybe been a bit over reliant on like a specific region. Whereas Binance definitely, I wouldn't even classify it as like an Asian exchange anymore. It's truly
Yeah,
global and dominant around the world.
yeah, I do the same. Exactly, treat Binance as a global exchange.
But looking at actually, yes, so looking at token returns. So each of these exchanges, I thought it would be interesting to chart the exchange tokens. So what is an exchange token? Many centralized exchanges, including Binance, Huobi, and OKEx, they've issued their own cryptocurrencies, which can be used for lower fees on trading. You can earn staking rewards, you can vote on listings. But ultimately, I think everyone knows this, that when you buy a token, you're really betting on the success of this exchange. And therefore, the prices are often linked to news that happens regarding these exchanges. So here I charted returns for exchange tokens through September and into October. And we can see that there was an almost instantaneous effect on exchange tokens right when the Chinese crypto ban was announced on September 24th. And this effect was actually strongest on Huobi. We can see that prices plunged. And in just the past like 45 days, the token is down more than 50%. And so this is definitely evidence that traders who are, I guess, betting on the success of these exchanges really think that this is like ultimately bad news for these exchanges. And so I always like to look at returns as sort of an indicator for how the markets are considering exchanges as a whole. And of course, year to date, all tokens are still up. That's because there's been a huge bull run. But looking at just the past month, we can really see where this trend plays out. And so one other trend that I saw that a lot of people were talking about had to do with DEX tokens. So it's similar to centralized exchanges, but many decentralized exchanges also issue their own tokens. And right after the ban, we actually saw the opposite of the trend that what we saw for centralized exchanges. DEX tokens increased. So why would that happen? First, DEXs, they don't actually collect any information on their users. So technically, anyone with the right access is able to trade. However, I don't really like drawing these types of correlations. It's definitely a correlation. It's not necessarily a causation, but perhaps it was just the hype after this ban that caused especially DYDX's token to increase 81% in the week immediately following.
Yeah, and just to comment on that, I think the market loves a good story, and I think the rumor mill got going. Yeah, it's important to understand that the volumes on DEXs, while large, sometimes there's some issues of sort of double counting on that, just because of the way the data gets processed. But also the number of users who are actually using DEXs is really in the sort of tens, even low hundreds of thousands, whereas the number of people who are visiting these sort of more centralized exchanges really is in the millions and tens of millions. So it's not like everyone who was on Huobi has suddenly decamped to use a DEX.
Yeah, I agree. I also sometimes doubt the DEX volumes that we see. So, especially, we've also noticed the issue of double counting for DEX volume, especially when using our DEX data. So, that's definitely an issue and can't exactly be tied to the ban itself. So let's move on to our second trend of Q3, and that has to do with layer one protocols. So first, what is a layer one protocol? It's simply a term used to describe the underlying blockchain infrastructure. For example, Ethereum is known as a layer one protocol. But of course, there's more than just Ethereum that exists. There are many other what are called competitors to Ethereum, Ethereum killers. Here, we're just calling them layer one protocols, alternate protocols. But we have some, including Cardano, Solana, Terra, Avalanche, Phantom. These are all alternate networks that have similar abilities as the Ethereum blockchain, but they have their own unique features that ultimately they're trying to attract a lot of users. So we've seen really record-breaking returns to these alternate L1 protocols in Q3. We can see that most of them are actually triple-digit returns, and Phantom blockchain is up 709% since the start of July. A lot of this has to do with incentive rewards programs. So in order to attract users, these blockchain platforms will have a lot of rewards programs, and this will actually cause prices to surge. And we've seen this time and time again. But it's really interesting just to see the change that has happened in Q3. And so why is that? Why would someone choose an alternate layer one protocol over Ethereum? I'll let Philip take this.
Yeah, so really there's been an explosion of usage of layer one protocols. I'm sure everyone here has heard about decentralized finance. These different ways of using tokens, of earning yield and so on, have given people a reason to move their assets around on the blockchain. But of course, if you actually want to transfer assets on a blockchain, you have to pay fees. And we can see here just how big an impact that's had for Ethereum. So Ethereum is the main layer one protocol where you can do more than just transfer an asset, and because of its smart contract capabilities. Bitcoin, on the other hand, it's the grandfather, but it's a little bit boring because all that you can really do is you can move your Bitcoin from one wallet to another. And that means, as these DeFi applications have turned up, more and more people have been willing to pay to actually use the Ethereum blockchain. And so we see that actually the cumulative dollar value of all the fees on ETH overtook that of Bitcoin in February of this year, and now totals $6.8 billion. And all of these competitors are really in the market for trying to get other people to come and use their blockchains and therefore pay them some fees. When a protocol gets popular, the ETH network gets jammed up, it runs out of bandwidth, and fees jump. So people just choose to go to the other layer ones. And $6.8 billion rising very rapidly, that's a lot of cash to incentivize people to set up a new layer one and start claiming some of those fees as they provide bandwidth to all these new applications.
Yeah, and it's going to be really interesting to start looking at the actual usage of these alternate networks, because ultimately price returns, that's not a great indicator. Even trade volume, there's so much speculation happening in crypto that it's hard to sometimes divorce the actual speculation with network usage. But Philip, I know you'd mentioned that this data is a little complicated to work with. So do you want to talk about that for a bit?
Yeah, absolutely. So one of the reasons why all of these other protocols are so attractive to people who want to do lots of complicated things on them is because they allow you to produce and transmit much more data on the blockchain than you could on, say, Bitcoin or sometimes even ETH. But of course, from a data analytics perspective, that just means there's so much more data to now process. And you're no longer just looking at data that's like transferring an asset from one wallet to another. you're essentially trying to decode the interactions of many different computer programs and turn that into some actionable insight about how an asset got transferred. So there's just much more data, and it's much more complex when you start looking at things like Solana. And so really it just takes a bit of time for the data analytics to catch up with the actual use case.
Interesting. Yeah. I mean, as we add more blockchain data sources, we're gonna start looking more into this data to see the usage.
Absolutely.
So my next chart shows the market structure on an exchange of all layer 1 tokens. And so these are the most popular ones. It's not all layer 1 protocols. It's really the ones that have gotten the most hype and attention over the summer. And I charted the market share of trade volume on Binance, comparing Ethereum to these alternate protocols. So we can see that in January of 2021, 80% of all layer 1 volume was to Ethereum. However, by September, this number has fallen to just 35%. So this really shows just how quickly other layer 1 protocols and just altcoins in general can rise and fall in popularity. And here we see some of the, one of the biggest winners, of course, is Solana. Solana has seen some of the best returns, the most usage over the past few months. And we can see that reflected in trade volume on Binance. And another data point I like to look at is order book liquidity. So this shows that on Binance, again, I charted the bid-ask spread, and we can actually see that in just 1 month of data, the spread really narrowed a lot, which means that liquidity in such a short time improved really sharply. And you don't really see this that often. For example, for Ethereum liquidity is flat, it's consistent, it's stable. But when you have new altcoins enter the scene and they become more liquid, there's more market makers, you can really observably notice how this improves over time. So that's finishing our layer 1 section. And now to one of my favorite topics recently to discuss is stablecoins. So a lot has happened in stablecoins over the past few months, particularly on the regulatory front. So what we're seeing now is not yet a crackdown. There are no rules really banning stablecoins yet, but what we see are a lot of talk around politicians, the media, regulators in particular in the United States, and all are focusing on the breakdown of reserves of stablecoins. So what do I mean by that? So when you buy a stablecoin, the idea is that there is 1-to-1. So you give $1 to an issuing organization, and they will generate one stablecoin that should be pegged 1-to-1. However, what we see is that not all of these issuing organizations actually have 100% of their reserves in US dollars. And so here I've compared USDC, which is a stablecoin, and USDT, which is a stablecoin. And these are the breakdown of reserves as reported by the issuing organizations for both Tether, which issues USDT, and Circle, which issues USDC. And what we can see here is that USDC has 61% of reserves in cash and equivalents. And then you look at Tether, and this is also reported, that's only 10%. So that's, I would say, quite concerning for a regulator who sees this information, especially considering that Tether now has a nearly 69 billion market cap, which would actually rank it within the top 50 financial institutions in the United States. So it's definitely no wonder that regulators are starting to pay attention, especially as there's risk when you hold a percentage of your reserves in stuff that's not cash. There's risks of a bank run, there's risks of default, and it's quite interesting actually when you dive into the reserves. So now I wanted to look at some of the actual market data. So just how important are stablecoins in the cryptocurrency ecosystem? So here I charted the stablecoin volume across all exchanges in Kaiko's collection. And I chose the top 3 stablecoins, which are USDT, that's Tether, USDC, Circle, and BUSD, which is Binance's USD stablecoin. We can see here that it averages nearly 80 to 100 billion in volume every day. And that's a lot. Most crypto assets get just a fraction of this every day. So now I want to actually look at the market share. Not all stablecoins are created equal. Some are more dominant in crypto than others. And of course, everyone knows that that's Tether. We look here, and stablecoin market share has been quite consistent over the past 3 months since the start of Q3. We can see that Tether currently accounts for around 87% of total volume out of the top 3 stablecoins. BUSD ranks second at 10%, and USDC is third at around 2%. One thing to note, though, is USDC has found a niche in DeFi and particularly lending protocols. And so USDC actually has a wider range of use cases outside of centralized and decentralized exchanges and more in the DeFi ecosystem. But it's still interesting to see just how dominant Tether is. So here is one of my favorite charts. I made this last week, and I really wanted to see for every Bitcoin purchased, how much of that is in stablecoin. So I charted every single pair that includes Bitcoin as either the base or the quote asset. And so this is volume aggregated across all exchanges in our collection. It's a huge amount of trade volume that we use to produce this chart. And we can see here that 50% of every Bitcoin trade is executed using Tether. And so this is out of the more than 1,000 pairs that exist that have Bitcoin as either the base or quote. So this is massive, and this really shows just how dominant Tether is for all of cryptocurrency, not just within the stablecoin sector, but all of crypto. We can see that the second closest pair is ETH BTC, which is just 13% of volume, and BTC USD, that's the only fiat pair that actually ranks in the top 5. It's just 6%. So compared to Tether, 50%, it's quite fascinating to see just how dominant Tether is. And so now let's talk a bit about on-chain. And I really think this chart is great, but it's a little complicated, so I'm going to let Philip take it away.
Thanks. Yeah. So to really, I guess, explain the motivation for this chart before I explain exactly what it is. And one of the fascinating things about on-chain data is that we can see the flow of the underlying asset in and out of an exchange. One of the missing pieces, if you like, on the centralized exchanges is we don't know how much fiat has been deposited to the accounts of traders on that exchange. So we don't know how much sort of dry powder there is. But on the blockchain, we actually can get a sense of that, because when, say, Bitcoin and ETH are sent to an exchange, it's typically being sent to be sold. But when stablecoins are sent to an exchange, well, as we just saw, typically they're being used to buy, say, Bitcoin or ETH. And so we've got the asset that's coming in to be sold, but we've also got the asset that's coming in to buy those assets that are about to be sold. And so we can look at the value of all the Bitcoin and ETH going into exchanges relative to the value of the stablecoins going into an exchange. So for example, if there was $1 million worth of Bitcoin and ETH sent into an exchange on a day, and there was $1 million worth of stablecoins going in, then we can sort of make the assumption that actually 100%, all $1 million of that Bitcoin and ETH are being bought using stablecoins. And then when that percentage goes less than 100%, that suggests that there's some other assets being used to buy this Bitcoin and ETH. Potentially that's a Bitcoin ETH trade, or as I think often happens in these instances, fiat is actually buying that Bitcoin and ETH. And we actually saw a really interesting thing in Q4 of last year, and then really in the first half of this year, where the percentage of stablecoin inflows relative to the Bitcoin and ETH inflows went below 50%. And that to me suggests that actually the big price rally that we saw at the time was driven by fiat rather than stablecoin buying. However, that actually now seems to have changed. It jumped up. Stablecoins started buying more of Bitcoin and ETH in July, started to go down, I think, as we saw a bit of a fiat, reignition of fiat interest a few months ago. But then very recently, this most recent rally, we've actually seen stablecoins flow into exchanges more than we have in the past relative to Bitcoin and ETH that's coming in. Maybe that's actually due to people in Asia or in China who are holding stablecoins and potentially want to convert that into Bitcoin and ETH. There's definitely been very large holdings of stablecoins in the region. We know that historically. So for me, this is just a fascinating chart to understand how much how much fiat buying is going on versus stablecoin buying. And it really helps, I think, get some context into the trade volumes, because there you'll just have a lot of market makers who are sort of buying and selling and creating a very large amount of trade volume, whereas here you might be actually getting an idea of the underlying assets that are actually being used to buy others. So you get a picture of the change of the stock rather than the just flow of trade volume.
That's really interesting. And actually, I was just preparing for the newsletter this week, and I saw that the volume, the ratio of tether to dollar volume for Bitcoin has spiked over the past week to levels that haven't existed in like more than 6 months. And so it's clear that there's both buy and sell volume for Bitcoin tether pairs. That is really just spiking in the market right now. And I'm not really sure exactly where it's coming from, but it's likely from Binance, OKEx, and Huobi. So now we are moving on to our final Q3 trend, and this has to do with the macro environment. So macro increasingly affects crypto, and I think the analysis is more and more relevant. And I've even seen all of the crypto analysts in the industry that I read, I notice that their writing increasingly includes references to what's happening in equities markets, what's happening with the Fed, what's happening with inflation. And I think this is because Bitcoin is no longer, and crypto is no longer an isolated asset class. It's really integrated into global macro market movements. So that's actually why Kaiko Research added our macro newsletter section this summer to reflect this growing relevance and the fact that it is important. Crypto is not just isolated anymore. So a lot has happened. This has been a hugely eventful summer for the global finance industry. A lot of that has to do with inflation. Inflation has pretty much been greater based on the CPI, greater than 3% since May. And actually inflation numbers again came out today, and they're also high. And so this is causing a lot of jitters throughout global financial markets. And so why is that? People think that inflation will cause the Fed to turn off the tap. What that means is the Fed has been buying a lot of bonds since the pandemic started, and inflation will likely speed up the tapering. So it's known as tapering when the Fed will stop their bond purchases. And so markets are really, nervous right now because risk on assets like equities, and some classify crypto as a risk on asset, these will likely be hurt should the Fed ease their monetary policy. And so that has caused a lot of volatility in the markets. And in September, actually, equities had their worst month since the start of the pandemic. And yes, here actually I chart CPI versus Bitcoin, and Bitcoin, of course, is not always correlated, but we see here that Bitcoin often acts independently. And my next macro chart is rising yields. And so what we're going to be looking for on the Kaiko Research team in the next few months is how cryptocurrency markets react to a growing global risk-off environment. And so yields have risen over the past few months. And they've risen in response, and they've risen as investors turn to bonds. And so, like, as yields rise, investors will often divest from risk-on assets like equities. So it's interesting to see if this will actually impact Bitcoin in the long run. So yes, that is the last slide that we have here. Now we'll take some time to answer some questions and maybe dive deeper on some topics. So let's see here. Our first question is, how can we explain enormous volumes observed on decentralized exchanges relative to the small number of users of those DEXs? So that's a good question. So I actually did a little analysis on trade sizes for DEXs earlier this summer, and I found that trade sizes are extremely large on DEXs. I think they averaged on Uniswap to more than $50,000 per trade, whereas on an exchange like Binance, it's on average $2,000 per trade. So this would definitely explain the enormous volumes with a relatively small number of users. I guess it's just whales doing a lot of trades on DEXs. But Philip, I know that Chainalysis recently did an exploration of DEXs. So maybe you can speak a bit on that and what you've seen on chain.
Yeah, so I mean, it definitely echoes what you said there, that there's a lot of whales who are getting involved and they tend to trade larger amounts. Really, I think you've got to have, if you like, be sort of pretty crypto native, already actually have enough ETH that you're willing to spend in fees, and understand the crypto ecosystem well enough to understand the opportunities that are on DEXs. So it is a more sophisticated group of participants, and they're just trading a lot more. The other interesting thing I think is at least from an on-chain data perspective, there's a lot of what we call gross activity for a relatively small amount of net activity. So, a lot of assets need to move through the different smart contracts to actually end up just swapping a pair of assets, because all of, if you like, the computation that would otherwise be kept on a centralized order book is actually happening on the blockchain. And that's why sometimes if you don't clean that out, the volumes can look really enormous. But even if you do clean that out, the volumes are still very large for exactly the reasons that Clara said.
Yeah, it's really interesting. I've always wondered like how it's profitable to trade on a decentralized exchange simply because fees are so high at this point. And it definitely excludes, like I would say, your average trader who can't pay those fees and also doesn't want to compete with all of the people front running. Okay, question number 2. Do you have any commentary around the 1.6 billion BTC buy that reportedly took place within 5 minutes last week? Yes, I read that article. I thought it was interesting. However, I will say it's very difficult to place a single like buy order. It's difficult to identify this across exchanges simply because markets are so complex. They're overlapping, they're intertwined, and it's really difficult to find an order on one exchange and say this is why the price increased. I would say it's often like when someone places a large order, it can ripple through markets, it can cause automated orders to execute. So you can't ever really like determine that one order caused the price to increase because you also don't know who the trader is. You don't know if it's one person or a group. So that's my comment on drawing these like causal, I guess, links between orders and price movements. So I don't really have comments on why it happened. What I like to do is look at market share and see if the market share fluctuates of exchanges. You can sort of pinpoint where inordinate volume happens. For example, if Binance market share spikes, you can assume that buy volume or sell volume probably happened on Binance. Any comments on that, Philip?
No, that's very much the kind of world of understanding the order books, and that's where I kind of leave the expertise to you.
Okay, third question, what's your view on the future of stablecoins in terms of regulation? That's a good question. We'll see what happens in the United States. I'm sure regulation is coming. However, like Tether in particular, I don't think is actually based in the United States. I think USDC Circle is going to work closely with regulators. And I think that's going to be a strategy that will ultimately, in the long run, be very beneficial because regulation will definitely be coming.
Yeah, and maybe to add to that, I think it's important to understand, we've talked a lot about how stablecoins are used as the other side of so many crypto trades, and that is definitely like a core use case. But we can actually see, for example, on the blockchain that more Tether has now been held for between 1 to 6 months than is held for less than 1 month. So actually, people aren't just holding Tether for sort of short term, as they go in and out of positions, but actually it's kind of sitting in wallets for longer and longer. So actually, these billions of dollars of Tether, some people may be using them as actually a means of saving. We actually see a very large number of low value sort of peer-to-peer transfers on Tether as well. So that's between sort of two self-hosted private wallets, which suggests that actually there may be parts of the world where Tether's been used as a means of exchange. So there's really been an explosion of use cases. It's Tether and stablecoins, I think, have a future beyond just being a financial asset that's used in trading. And that means you start to get into the world of, everyday customers holding this asset. And that's where, certainly a country that thinks it has a monopoly over sort of dollars and dollars equivalents will start to take a stand. There's kind of everyday people who are now using this and it looks like a dollar, so they're going to have a regulatory opinion about it. In some ways, that's kind of going to be valid. The other thing I'd say, so I guess what I'm saying is that stablecoins are increasingly looking like money rather than just a sort of traditional, maybe untraditional counterparty to a financial trade. The other thing, though, I would say is, crypto has only ever become more regulated over time, and it's only become sort of a bigger, more valuable industry over time as well. So I don't think it's going to be a major roadblock. I actually do think getting a better regulatory framework around stablecoins is really important. We've they've demonstrated there's product market fit. They've demonstrated that people want them. Let's kind of make sure that there's some regulatory safety lines for their greater use.
Yeah, I personally think stablecoins are so fascinating. And out of like all of the different crypto use cases, stablecoins, I would say the use case is strongest. There are just so many applications for how a stablecoin could benefit so many different types of industries. Yeah, I'm really interested to see how the partnerships in particular are going to work out with like Visa, MasterCard, especially remittance programs. And those, all of them are interested in stablecoins right now. And it's going to definitely be the year of stablecoins, I think. So. Okay, last question. Due to the reported institutional adoption over the past year in possible Bitcoin ETFs, what are your thoughts on the possible change in these larger boom bust cycles that crypto markets follow? I guess in the context of like larger participants. I definitely think that the approval of a Bitcoin or Ethereum ETF will be like one of the strongest, I would say, bullish signals yet for cryptocurrency markets. It's been truly year after year after year in the making. There have been so many, I would say, like, there's been so many rejections and thus far. And I think that could really have the potential to change a lot in crypto once we see that approval happen. Philip, comment on that?
Yeah, so I think we shouldn't underestimate the it's not just the reported institutional adoption. It's actually like really clear there has been institutional adoption. You can look at Coinbase's reported numbers on the amount of institutional business they do. We can also look again on the blockchain, and we can see the amount of Bitcoin that's held in wallets that say hold over 1,000 Bitcoin, which is kind of $50 million or more, sometimes much more. What's been fascinating is that pretty much almost immediately from mid-March 2020, when financial markets across the world sold off, these sort of whale wallets started accumulating. And they weren't just sort of old whales, they were actually new entrants into the market. And that really continued up until January, February of 2021. And then they kind of sold off a bit and have kind of re-entered recently. So there really is that institutional demand there. There's not many sort of retail customers out there, although there are some in crypto who can buy $50 million worth of Bitcoin. The key change that has brought into the market for me is that actually the cost basis of Bitcoin and ETH has risen dramatically. So for example, if you go back even just 2 years ago, the average cost of new investors buying Bitcoin was around $10,000 per Bitcoin. It's buying and holding, so the value of the Bitcoin that they continue to hold. Now it's over $40,000, about 41,000, I think, at the moment. And so what that means is there's a large number of people who are willing to buy and hold Bitcoin at $41,000 rather than just $10,000. So if the price were to fall below that, well, Bitcoin would seem like a good deal for them, and they might start buying, putting a floor under that price. But also more importantly, it means that they really have skin in the game to make this industry work. Like, just don't underestimate how much money has come into the industry in the last 18 months. And I think that gives it a huge momentum. I think that's maybe why we might see an ETF be approved. But I guess a final thought on the ETF is, because an ETF has been so long delayed, I think the rails for people to buy Bitcoin have just improved immensely. You could buy some shares in Coinbase. You can get Bitcoin on Robinhood. Yes, an ETF will open up crypto to a wider audience, but actually a wider audience has already got access to crypto. So I think it'll have less of an effect than it would have, say, in 2017.
Yeah, really good point. Is like now almost every company, sort of, not every company, but you see a whole new wave of infrastructure providers that are designed for institutions. Like you have custodians, brokers, that it's actually easier than ever to get exposure to crypto without having the risk of like managing it yourself. Great. Well, that's our last question, and we're actually almost at time, but thank you everyone for joining today. Email me at clara@kaiko.com if you have any feedback. And thank you so much to Philip for providing some awesome insights on on-chain data and crypto as a whole. And thanks everyone for joining.
Thanks so much.